Welcome to Course 06 of the MaxLife Commercial Academy. I'm Ryan Solberg, real estate broker with MaxLife Realty, and today we're going deep on one of the most underrated skills in commercial real estate, market and submarket analysis. Most investors spend 90% of their time analyzing the deal and almost no time analyzing the market the deal sits in. That's backwards. The right property in the wrong market will underperform every time. By the end of this course, you'll know how to evaluate an MSA, drill down to the right submarket, and even identify the right corner before the pricing reflects it. Let's get into it. Let's start with the single most important distinction in this entire course: the difference between deal first thinking and market first thinking. When you lead with the deal, you focus on the cap rate and the price. You fall in love with a number on a marketing flyer. The problem is that a cap rate tells you nothing about the demand drivers sitting underneath the asset. Deal first thinking leaves you vulnerable to local economic shocks. It relies on the current rent instead of the rent trajectory, and it completely misses structural vacancy risk, the kind that shows up when an anchor employer leaves town and there's nothing pulling tenants back. Now contrast that with market first thinking. You start with population and job growth. You understand who is moving into the area and why they're coming. You identify the industries that are anchoring demand. You read the rent trends before you ever make an offer, and you position yourself ahead of the path of growth. Here's the principle I want you to take away, and it's the formula on the screen. A strong market with an average deal will outperform an average market with a strong deal almost every single time. The market is the tide, and the deal is just your boat. You can buy the best built boat on the lot, but if you put it in a stagnant pond, it isn't going anywhere. Get the market right first, and good deals become much easier to find. One of the most important mental shifts you can make as a commercial investor is learning to separate the signals that predict market movement from the signals that describe what already happened. Leading indicators give you a head start. Job announcements are the most powerful. When a Fortune 500 distribution center announces a new facility in a submarket, the land around it will reprice before that building is ever finished. Permit activity is similar. Builders don't pull permits speculatively. They pull them when they have signed leases or very strong pre-leasing. So a surge in industrial permits in a corridor tells you that large tenants already committed to that location. On the lagging side, published cap rate surveys are dangerous if you treat them as current data. A report released in March is built from deals that closed in the fourth quarter. The market may have already moved 50 to 75 basis points. Same with vacancy reports. They're compiled from signed leases, and there's always a lag between when space gets absorbed and when it shows up in the data. Use lagging indicators for context, but never let them drive your timing. Demographic data sounds dry, but it's actually the foundation of every good market thesis. Start at the MSA level. You want to see population growth of at least 1.5% annually. That's the threshold where demand for housing, retail, and services consistently outpaces supply additions. If you're looking at Central Florida, which is our home market here at MaxLife Commercial, you're seeing MSA growth in the 2 to 2.5% range, which is exceptionally strong by national standards. Median household income matters because it sets the ceiling on what retail tenants can charge and still drive traffic. A submarket where median HI is climbing tells you that tenant sales volumes are going to follow. Age cohorts are critical for asset type selection. A submarket skewing 25 to 44 years old is forming households, starting businesses, and moving frequently. That strong demand for multifamily, neighborhood retail, and small bay industrial. Migration data is one of the most powerful signals available right now. Domestic in-migration from high-cost metros is compressing cap rates in Sunbelt markets because new residents arrive with more spending power than the existing population base. Don't ignore that dynamic. Absorption, vacancy, and rent trends are the three core supply-side metrics in commercial real estate, and you need to read them together, not in isolation. Net absorption measures the change in occupied space over a period. Positive net absorption means tenants are taking more space than they're giving back. 3 or more consecutive quarters of positive absorption in a submarket tells you that demand is real and structural, not a one-quarter blip. Vacancy rate is a snapshot. What you're really watching is the direction and speed of change. A submarket at 8% vacancy trending down toward 5% is a far better investment environment than one at 5% trending back up to 8. Rent trends are the output of the supply-demand equation. When absorption is strong and vacancy is falling, landlords gain pricing power and rents follow. You want to see asking rents up at least 3% annually. Anything above that in a submarket is a signal of undersupply. The danger signals are equally important. Watch for rising sublease availability. That's a leading indicator that large tenants are contracting before their leases expire. And always compare asking rents to effective rents. A market where landlords are offering 6 months of free rent is not as healthy as the headline vacancy numbers suggest. Retail site selection is as much science as it is instinct, and the science starts with traffic counts. Annual average daily traffic, AADT, is the baseline. The Florida Department of Transportation publishes this data free online down to individual road segments, and you should pull it before you ever make an offer on a retail property. Understand that the type of retail matters as much as the count. A gas station and convenience store can thrive at 15,000 and AADT. A sit-down restaurant needs 30,000 or more to drive enough impulse traffic. Daytime population is often overlooked by investors who only look at residential census data. In submarkets with large office parks or industrial corridors, the daytime population can be 2 to 3 times higher than the people who sleep there. That workforce drives entirely different retail categories: fast casual, fuel, and personal services. Ingress and egress are the deal killers that show up late. A site can have spectacular traffic counts, but if the nearest median cut is 800 feet away and the site has no left turn deceleration lane, national tenants will pass. Always drive the site at peak hours in both directions, and co-tenancy matters enormously. Proximity to a grocery anchor is worth more than almost any other site factor because grocery stores generate 3 to 5 trips per week per household, and every one of those trips is a cross-shopping opportunity for your tenant. Identifying the path of growth before prices reflect it is the highest value skill in commercial real estate. It's how investors generate outsized returns, not by finding undervalued deals in mature markets, but by correctly identifying which corridor is going to be tomorrow's submarket. The signals are hiding in plain sight if you know where to look. Infrastructure investment is the most reliable leading indicator available. When FDOT or a county commits to a new interchange or road widening, that decision went through years of traffic studies and growth projections. The public sector doesn't build roads to nowhere. They build them where population is already committed. Master plan communities are another powerful signal. An approved MPC with 5,000 units is a guaranteed future rooftop count. Retail and service demand follows within 3 to 5 years of groundbreaking, and industrial demand for last mile distribution follows even sooner. Anchor tenant announcements move land values almost immediately. When a major employer announces a facility, land within a 2-mile radius reprices within 90 days, before permits, before site prep, before a single worker is hired. That's the window where patient, informed investors capture the arbitrage. Here at MaxLife Commercial, we track these signals actively across Central Florida. If you want to talk through a specific submarket or corridor, reach out directly. Our number is 321-586-2121. Everything we've covered in this course comes together in the market brief. The goal is a repeatable 30-minute process that you run before writing any letter of intent. Here's how I structure it at MaxLife Commercial. Start at the MSA level. You need population growth rate, net migration trend, the top 5 employers, and current unemployment. These are all free. Census Bureau, Bureau of Labor Statistics, and your County Economic Development Council website will have everything you need in about 15 minutes. Then drill to the submarket. Pull the last 4 quarters of net absorption, the vacancy trend, and asking rent growth. If you don't have a CoStar subscription, ask a local broker for their most recent quarterly market report. Most firms publish these and will share them freely. Then pull your traffic counts from the DOT portal and run your 1, 3, 5-mile demographic rings from a free tool like ESRE Community Analyst. That's another 5 minutes. Finally, spend 5 minutes scanning local news. The Orlando Business Journal, your county planning portal, and the local EDC announcement board will surface any major announcements from the past 90 days that could be the catalyst or the risk you missed in the data. The final step is the most important. Write your thesis in 2 sentences. If you can't do it, you don't have clarity yet. Keep researching. That discipline will save you from more bad deals than any due diligence checklist ever could. That wraps up Course 06, Market and Submarket Analysis. You now have a complete framework for evaluating commercial real estate markets from the MSA all the way down to the right corner. The most important habit you can build from this course is running your 30-minute market brief before every offer. It sharpens your thinking, strengthens your negotiating position, and protects you in due diligence. Up next is Course 07, User Decision Analysis, Lease versus Own, where we'll walk through the full framework for helping tenants and business owners make the right occupancy decision. If you have questions about a specific market or deal you're analyzing, I'm Ryan Solberg, real estate broker with MaxLife Realty, license number 3354351. You can reach me directly at 321-586-2121 or visit us at maxlifedevelopment.com/academy. Thanks for being here. I'll see you in the next course.